Welcome everybody to the webinar. My name is Clay Malcolm here at Advanta IRA, and I'm delighted to be joined today by Josh Lloyd and Joe Ashkudi, co-founders of yieldi. They're going to be our expert guests today, and what we're going to be talking about is debt investments in your self-directed IRA. The presentation is going to go self-directed IRA, a little self-directed IRA information first, and then we'll bring Josh and Joe on to do the bulk of the presentation and talk about their experience and share their expertise with us. I'm happy to have you guys ask any questions that you might have. So in your console there, you should see a questions box. Please feel free to type into that questions box the questions as they come to you. If we answer it during the presentation, great. And if not, we will definitely answer it after at the end of the presentation part. This event is being recorded, and you will receive an automatic email that kind of gives you a link to the recording and some information and places to get a hold of us for questions and things like that. So don't fear that if you miss something that you'll never get to see it again. It'll also appear on our YouTube channel. So happy to have you visit our YouTube area on our area on YouTube there. And so without further ado, I'm going to go ahead and get started, and we'll bring Josh and Joe on here in a little bit. So I always like to, obviously start with a disclaimer, and that is basically that at Advanta IRA, we do not give tax, legal, or investment advice, and all the information that you're going to see here today is for education purposes only. We absolutely encourage you to use your financial team and your legal team when you're investigating any type of investment that you may want to invest in with your IRA or with your personal funds for that matter. Again, and most disclaimers are a little bit of a throwaway, but I do feel like this one's informative in terms of our role at Advanta IRA in the equation, which is we're a very neutral part of the investment scenario. Our job is really to document the activity of the account such that you get to keep the tax advantages of that are associated with the account type. We don't tell you what to buy, when to buy, any kind of investment strategy. We're not advisors in any way, shape, or form. And so we're really just there to listen to what you want to invest in and help you get your tax advantaged account invested in that particular opportunity. And sometimes the terminology self-directed IRA is a little bit confusing for folks because it does get misused sometimes. So just to be clear, most of the time when you're talking about a self-directed IRA, really what you're talking about is the ability for your IRA, whether it's a traditional or Roth or other account type, to invest in alternative assets. That's typically the most common utilization of the term. Now, the fact of the matter is self-directed IRA it's a descriptive term. It's a marketing term. It's not really an account type. It's not a legal distinction. So really what it indicates is that the account holder will have some sort of choice in terms of what assets or investments their tax advantage money is going to purchase. So a self-directed IRA at a Schwab or a Fidelity means that they're probably going to give you a list of, let's say, mutual funds and stocks and maybe some ETFs and things like that, and you choose from those. So it's self-directed, but it is limited to publicly traded securities because those are the assets that they handle. Whereas a company like Advanta, we actually take the other part of the spectrum, which is we handle alternatives. So hard assets like precious metals and real estate, debt instruments, private equity, things like that. So we specialize in things that are not publicly traded. And interestingly enough, the IRS does not say to IRA custodians, hey, you have to handle all of the assets that are allowable by law. That's not the way it works. The custodian gets to choose which assets they handle. And that's an important thing for you as an account holder because you want to have your IRA money at a custodian that handles the assets that you want to get into. So that's the match that you're looking for. And we'll talk a little bit about the fact that you can have multiple IRAs operating simultaneously. So it's very common for somebody to have an IRA at a bank or brokerage house and also have one with Advanta. And in the bank or brokerage house IRA, they're in their stock investment mode, and with Advanta, they're into real estate or debt or any of the other things that we handle. So you can have multiple IRAs. You can move that money around, usually without tax or penalty, to position it at a custodian where it can be utilized in the investments that you want. And here's a really short list of the things that we work with at Advanta. So as I mentioned before, real estate, and real estate is multifaceted as well. Today we're going to be focusing on debt instruments or private lending, and that's a really attractive asset class when it comes to self-directed IRAs and maybe also for with your personal funds. Like I say, we do private placements, cryptocurrency, precious metals, and much more. Really, almost anything that you know how to make money at outside of your IRA, you can make money at inside your IRA as long as you take the time to set it up properly. And obviously have your account at a custodian that handles those assets. So I mentioned the fact that self-directed IRAs are not an actual account type. The account types are the ones that you already know. So the traditional IRA and Roth IRA are obviously individual accounts, as is a health savings account. A lot of people don't know that a health savings account is not use it or lose it like a flex spending account. It actually persists through time. It's an individual custodial account, and it operates very much like an IRA. So once you've put money into it, it can invest through time, and then you take distributions as you desire, and the account stays open until you take distribution of everything in it. So think about it. If you have the ability to get into an HSA, that is another way that you can invest in these alternative assets, and it also has tremendous tax benefits. We also handle solo 401ks, SEP IRAs, simple IRAs, and covered L ESAs. So all of these account types can be invested in these alternative assets that we're talking about. And certainly today we're going to have, our experts are from yieldi, and they're going to be talking about debt instruments, and your IRA can invest in those. So remember that the contribution rules, the distribution rules, and the tax advantages of these account types they all stay the same. The only thing that is self-directed about it, or in this case, alternatives, is that instead of this money with those tax advantages buying a stock or a mutual fund, it's going to buy into some debt, or it's going to buy a piece of real estate, or again, any of those other assets that we talked about. So, and by far and away, the most common scenario for somebody in a self-directed IRA is they have an old 401k at a company where they no longer work, or they have an IRA somewhere and it's not performing the way they want to. So they'll open an account with Advanta. They'll move those funds over via rollover or transfer. That's not taxed and it's not penalized, and that will be the money that they then direct into an alternative investment. And obviously today we're going to be talking about is a debt instrument, but it's based in real estate. And like I say, real estate is kind of multifaceted. So do understand that in this space of real estate that we're going to be talking about today, there are all kinds of things that you can invest in. So residential and commercial, fix and flip, fix and hold, buy and hold, buy and develop, and any of the financial instruments that are associated with real estate. So lending, trust deeds, tax liens, all those types of things. Again, almost anything that you have some expertise in, or that your real estate team has expertise in, is a possible investment for your IRA. And that's one of the things that I think is really cool about self-directed IRAs, is that you as the account holder, or me in this case, I've been a self-directed IRA investor for 10 years. We bring the motive force, and we get to bring our team, right? So at Advanta IRA, we don't actually supplant anybody or move anybody out. We're actually an addition to your team usually. And so we encourage you to bring your CPA, your CFP, your realtor, your financial advisor, your family, any of those people that help you to make decisions. They all get to participate in what your IRA is doing. And a little bit about the basics. Do remember that your IRA is a legal and financial entity that's separate from you. And the reason it's kept separate, obviously, is it has different tax status than you do personally, or that I do personally. And so remember that anytime you are investing your IRA, it needs to be invested in the name of the IRA, not you personally. Because again, your IRA has its own name, has its own bank accounts, and it has its own tax ID number that is separate from your Social Security number. So do understand that the IRA is the investor, not you personally, and the returns come right back into your IRA, and that's how they achieve that tax protected status, or have the tax advantages that are associated with the account type. And since we're going to be talking about debt specifically today, why did I say that that's an attractive investment? Well, first of all, it's pretty convenient in terms of being an investor friendly type of opportunity. So it's the The terms of the return are already known, and they're relatively consistent in most cases. You don't have to do any property or business management, and you don't have UBIT because the principal and interest payments or interest profits are considered to be passive, and they don't have any UBIT consequences associated with them. And, as Josh and Joe are going to talk about today, you can get into debt instruments that are secured by collateral, which changes the risk profile on it. So all of these things are things to consider when you're choosing an investment of any type, and this is some of the features of debt. And I did mention that lots of people start their self-directed IRA journey with money that they've been contributing somewhere else. And I did put this chart up. It comes from the IRS website. You can find it there. And it just talks about the amount of the number of accounts that you can actually move money from and to. And you can make these moves anywhere that you see a yes there without tax and without penalty. Now, for most 401k plans and other qualified plans, you have to have either separated from employment, or the plan has to offer something called an in-service distribution, meaning that you're still working there, but you are allowed to roll over some of those funds without tax and without penalty, even while you still work there. But you can see on this chart the account types and how many yeses there are there. So I always encourage people to look at the tax advantaged accounts that you already have in play, take an inventory of that, and think about how do you want that how do you want that money deployed? How do you want it invested? And where do you need to put it? How do you position that to make those investments? So that's something to keep in mind. And the process for all this stuff in terms of having a self-directed IRA that can invest in alternatives is relatively easy in the movement of funds. So some people think it'll take months and tons of paperwork, and it's actually not that case usually. You can open your account with us in 10 or 15 minutes. It's just a short application. It's mostly personal information and beneficiaries and things like that. Transferring or rolling money over from other accounts, that in some cases that only takes a couple of days if you're moving it by wire. Sometimes check move, it takes a little bit longer. But you look at the accounts that you already have, you decide what you want to transfer or roll over, and you can also make contributions if you're eligible. So you've opened an account at Advanta, you put some money in it, and then you're out there looking for investments, and you're doing your due diligence on the investments, choosing what you want, letting us know what investments you want to get into, and then we help you to document that activity so you get to combine the tax advantages with the returns of the investment. And so that's really the sketch of how the self-directed IRA part works. And now I'm glad to be able to turn it over to Josh Lloyd and Joe Ashkuti. They're the co-founders of Yieldi. And while we're doing this, I'm gonna go ahead and get the screen changed over here. And yieldi.com is a really interesting website, and it offers the ability to invest in some debt instruments that you may not be aware that you were able to invest in. And these guys have an interesting background too, and I always like hearing about the multifaceted things that they've been interested in and also have expertise in. And so, Josh and Joe, are you there?
Yep, we're here. Can you hear us okay?
Yep, absolutely. You sound good. And hey, thanks a lot for joining us today. I really appreciate you sharing your expertise, and I'm going to go ahead and turn it over to you guys.
Awesome, thank you. Yeah, thanks Clay and the guys at Advanta for setting this up. We really appreciate it. Hopefully everyone will find this informative and get a better understanding of what we do and why we do what we do. Anyway, my name is Josh Lloyd. I guess I'll start since I'm already speaking, and I'll hand it over to Joe. Joe and I started the business about 3.5 years ago. My background was not originally in real estate or in lending at all, but actually on the technology side. So I moved to Atlanta, where we're located now. About 12 years ago, I had started a technology company called Shop Visibles in the retail and e-commerce space back in 2007, and ran that business for about 7 years and successfully sold it and exited out at the end of 2014, beginning of 2015. And when I went to go work for the company that acquired us, I had met a co-founder in a second technology business that was interesting to me, and went and started that business as well. And that was in the fitness space, and all software as a service. So learned a lot, and was able to grow that business much faster than the original one, and we exited that company after about 3 years. So within the span of about 3 years, I had the, I guess, pain and privilege of selling 2 companies, going to work for the company that acquired us, and got to a point at the end of that I just was tired, frankly. And so I was looking for different ways to allow my money to work for me, and started to lend money. And we'll get a little bit more into that, but that was sort of the genesis, my half of the partnership with Joe and forming Yieldi, and kind of it's 3 years later, and we've grown significantly since that point in time.
My name is Joe Ashcody. I'm the other founder of Yieldi. I grew up around real estate. My family's been in it for 50 plus years. My dad started a company a long time ago, and so it was kind of in our blood to grow up and learn real estate from a young age. In 2005, I started my career building a lot of grocery anchored shopping centers. We had a good relationship with Kroger and Publix, and we built shopping centers all around the Southeast. We built some mixed use projects. And then 2008, 2009 financial crisis hit. We were working out a lot of problems with banks. Everybody knows that banks stopped lending during that time for 4 or 5 years. And I was identifying a lot of property to build these shopping centers. And so I understood the markets pretty well, and I was seeing what stuff was trading for. And so I decided in 2010 to form a fund to raise some money to go buy distressed real estate. So we operated that business. We still operate it today. We bought a lot of fix and flip properties. We bought a lot of long-term holds. It was a great business. It slowed down a lot, but fast forward to 2013, we started to develop again. We saw a need for housing, and so we started building multifamily projects. We did that for 4 years, and then 2017, we felt like land prices were at an all-time high. Construction costs were starting to become a little bit uncontrollable. So we didn't really know what our costs were going to be from day to day. And we're very risk averse, conservative family. So we decided, hey, we still need to put money to work and be in the market. Why not try to identify some projects that we like, but just lend on them in first position, so our money's protected and it's low risk, low downside, and high interest. So I started lending in 2017, kind of like a mom and pop shop, very on just a few deals a year. And I ran into Josh and met Josh at the gym in 2019, and we were running around the building at 6 a.m. and we're talking about what we did for a living. And he told me he had sold 2 technology companies and was lending on a smaller scale. And I said, well, that's funny because I'm also lending and I've got a pretty in-depth real estate background. Maybe we should have some conversations about joining forces and trying to scale a lending business together. And so that's when Yieldi was born. That was 2019. And since Josh and I came together, Josh created with his technology background that the marketplace that we use to bring borrowers to and to bring investors to and connect the two, which is kind of how we syndicate our deals. But we have closed 80. We've got 80 loans right now on our balance sheet with different borrowers. We're close to 85 million in total loans out right now on the streets. We service all of our own loans. Since inception, I think we've had, and Corona was a big litmus test for our business, but we actually looked at it as an opportunity to grow and find great borrowers because all the banks and private investors stopped lending during that time. And we were one of the few active groups. So we picked up a lot of great borrowers. We looked at it as an opportunity to grow the business. And, we've had, I think since inception, maybe one deal that has gone into default. Everything else has been stable and has paid off, and we continue to work with the same borrowers over and over again. So they must like something that we're doing. Anyways, we'll move on to the next slide. I'll stop rambling on.
Yeah, so Joe covered a little bit of this, but back, kind of back to 3 years ago when, I really, for both Joe and myself, probably 4 or 5 years ago when we were individually lending money, you know, for me, my family had a lot of experience in different types of real estate on a much smaller scale than Joe's businesses and family's businesses. But, I took a hard look at, fix and flip and what would be involved and what are the risks and how to, identify properties. And my lack of experience in doing that, I looked at buying properties and renting them in college towns. Different ways to sort of generate passive income for myself. And every time I looked at different types of ways to put my own personal money out into investments, what I kept coming back to was the same thing. There's really no better way to do it than to lend money to folks that are experienced and let them do what they're good at and provide the capital, and then do that in a way that has very little risk. So I started looking at other things to lend money on, car collections or, various other debt instruments. And it always came back to real estate because, well, frankly, collateral doesn't move. So it's always there. You know where it is. You can get a lot of data on it. And so, like Joe mentioned, we built an online marketplace. And really what we did initially was it was a lot of my money, a lot of Joe's money. And to this day, we continue to put a significant amount of our own money in these loans, our family's money as well. And for me, very early on, when I started to do this, a couple of folks that had invested in my prior technology companies came and they said, what are you doing? And I told them, and they said, well, we would be interested in putting some money to work. And so I started to realize it was a really good opportunity, like Joe mentioned, to syndicate these loans, and started with just some friends. And where we were getting a certain interest rate that we were servicing the loan at, I was giving them a return that was very high. They were really happy with that. And then, when Joe and I started doing these loans together, we realized we could really scale this. And the only way we knew to scale it is technology, like anything else. So we built an online marketplace, and the way it works, we'll get into a little bit later, but it's pretty seamless. You get a loan, you look at a piece of property, you're like, yeah, I like that. I like that area. I know that area. Maybe I don't know anything about real estate. I want to lean on you guys to help me. But in either case, you basically can invest directly in a loan. It's very safe. We have first mortgage position on that loan, and our returns are high, for what we're talking about, a very low risk type of a yield product. Today, currently, our investors are making anywhere from 6 to 8, sometimes 9% on a loan in returns. And, if you compare that to a T-bill or something like that, which is significantly lower, there's a lot of interest in what we're doing. And so we're really excited about our future, and, we'll kind of keep going from there.
I'll jump in. This is Joe again, talk about this slide. So as a borrower myself and a developer, back in 2016, 17, when we were using banks to finance, development deals and build houses, I saw the inconsistencies and how tough it was for somebody with a lot of experience and a pretty strong balance sheet to get a loan. It was stringent. I had to pull our accounting team off everything they were doing in some instances for a week at a time just to get the bank all the documentation that they needed in order to get these loans. And I mean, I'm like, there's got to be an easier way to get this done. And so you can see that since 2008, and I like to say that traditional banks only lend to people who don't need the money. It's so tough to get a loan as a developer or an investor on anything besides, even your primary residence is tough to get a loan on. But if you go try to get a loan for an investment property, good luck. I mean, it is a very drawn out process and tough to get approved. And so you can see that on this graph that 51% of the market is now private lenders, which is pretty significant. It just shows you the amount of institutions that have seen this as an opportunity to get in and work with developers and builders to continue to build and help the economy grow. I think that the government had a lot to do with the regulations that were put on banks, and that makes it tough for them to lend as well. And so that's where we saw an opportunity is, hey, I've been on both sides of the coin, so why not have a process for these borrowers that's easy, quick, we can underwrite deals in typically 2 days. We've got a team of analysts that have been doing it for a long time, and we look at appraisals. We do our own property valuations to come up with our own value. We don't lend over 70% on the property, and typically our average is closer to 60% when a traditional bank is going to go a lot higher than that. So our investments are extremely safe. We've got our own money in every single one of these deals, like Josh said, so we're extremely conservative when it comes to underwriting. Most of the time, our values that we come up with internally are below the appraised value, and we're lending off our value for the property, not the appraisal value. So if it's call it $1 million loan, we're going to lend 600, maybe 650,000 on it. We're in first position. If anything goes wrong, then we're protected because we're backed by a piece of real estate that's got a pretty high value to it compared to what our loan amount is. We'll go to the next slide. This slide is just discussing again kind of what we've already touched on, that all of our offerings are asset-based, meaning that we're backed by a piece of collateral, whether that's and our portfolio is pretty diverse. We don't want to be heavily invested into one asset type. So we'll invest on, just because of our real estate experience, and our office is actually fully integrated. We've got property management, we've got analysts, we've got a sales team, we've got accounting. So we've got the ability to underwrite almost any asset type. But we like to lend on commercial properties. We like to lend on residential rentals. We'll do fix and flip. We'll do new construction, apartments. So we've got a very diverse portfolio of properties, and everything is in first position. So if the borrower defaults for whatever reason, then we would foreclose on the property and take it back, and then we would list it for sale. We'll go to the next slide. Why choose a debt product for an investment in your IRA? Because the same reason that Josh and I did. We wanted to find a consistent return that paid monthly, that was safe and low risk. And again, I don't know of any investment that's safer than a piece of real estate in today's market. With values increasing like they are, everybody's trying to diversify into real estate. And so we have a unique opportunity to offer to investors where, hey, look, we're going to be in first position on this piece of real estate, and we're getting 6, 7, 8, 9% interest rate returns on it. It's consistent. It's every month. It's only a 12-month bridge loan. So we're short-term loans. They're just bridge loans to help people gap, fixing up the property, getting them stabilized to go get cheaper money from, hopefully a traditional bank. But we collect from the borrowers on the 1st, and we pay our investors on the 10th. And I will pass it on to Josh for this slide.
Yeah, so the next 2 slides, we're going to go into a little bit more detail, sort of how the process works. But, we're not reinventing the wheels. I guess the first thing I would say, both Joe and I did this on a small scale, and I think over the last few years, especially, there was dozens and dozens of mom and pop private or hard money lenders in every state, and what you're starting to see is a little bit of consolidation. You're seeing a lot more institutional money come into the space, which is good because it basically is creating a lot of standards and good practices. And there's national law firms, there's national title companies, there's national appraisal companies. So it really enables us to do a very good job of vetting these properties. And like Joe mentioned, one of the unique things about us is our real estate experience. A lot of folks that will run these types of funds, they're technology guys like myself, and that's it. Well, we are very unique in the fact that we blend both technology and real estate. So we use the technology and our marketing experience to really bring in a lot of leads. And I would say that on a daily basis, if we brought in 10 leads in a day, we probably will discount immediately 8 of them. We'll look at the other 2, we'll take them through a process. And we've really done a good job of putting that process together. I think we have around 180 different data points that we'll look at on any loan. They vary based on the type of asset, if it's commercial or residential, or ground up construction or what have you. And we'll, using a little bit of light AI and our analysts, like Joe mentioned, we're able to do this very quickly. Typically, we can look at a deal, get some of the diligence reviewed, see what we need, and we can usually make a decision within about 24 hours whether we want to carry forward with that loan. At that point, we'll put a term sheet together with that borrower and outline all of the requirements we have of them that they need to bring to the table. And that's where we really get into our underwriting process. And within our underwriting process, that's where we do leverage a lot of technology. We don't rely on paper bank statements. For example, we rely on using APIs to pull data directly from the bank sources to make sure there's no fraud involved. And we have some really unique reporting to help roll up and understand their financials of the borrower. We understand, again, the properties based on different appraisals, broker opinion of value, our own comps, our own analyst team's able to look at them. So we'll go through that, make sure we collect everything we need, and if we feel good about the loan, we'll sign off. And again, from a process point of view, we're funding all of these loans 100% up front ourselves. We're putting them on our marketplace, and then when we make them available to our investors, just depending on what the loan is, we'll make anywhere from 50 to 80% of that loan available, and we always keep some money in every loan that we do. A little bit more on how the actual process works. So once you are signed up with us for receiving emails, and also you can check us out at yieldi on social media as well, on Instagram specifically. We'll put our offerings out usually about 48 to 72 hours in advance of making them available on the website. And so once those offerings are made available, you can log in, you can read about them, you can ask us questions. We will never replace, the people side of this. So, Joe and I and our head of origination, our head of servicing, other folks in our organization are always available both to our borrowers and to our investors. We think customer service is probably the biggest, one of the biggest differentiators to our business. We believe that's a very important component. So you can email us directly, ask us questions, why we like the property. If you see some discrepancy, even let us know. Always happy to take feedback. But once we make that offering available, you go online, and if you've shopped on Amazon or you've used any common e-commerce website, maybe like a Shopify or Magento type website, you're just going to go through a checkout. It's really, really that easy. So you find it, you hit the checkout button, it puts that property and that loan into a shopping cart, and it will ask you at that point, how much money do you want to invest of the amount available, tell you what the interest rate is, and then it'll also give you an option for how you want to actually pay for that investment. So it could be that you're just going to wire funds. That's great. It could also be that you're actually going to use your IRA to make that investment. And in that case, with our relationship with Advanta, we're able to take your order effectively, connect with our folks at Advanta, and get that process started so that they know how to wire us the money out of your Advanta IRA account. And once we receive the money, you're going to receive a document called a BPDN. So not to get too fancy, but effectively it's a promissory note, and it's very specifically securing your percentage of that loan's amount. So if you've invested 20% of the loan amount, for example, you're going to have a promissory note for that 20% secured against the loan. So if, like Joe mentioned, in the event of a default, in the event of like a catastrophic issue with our business, you've got that you're able to go back to and leverage that. So you always have access to that and secured against the collateral. Once that's signed, once we've received your funds, like Joe had mentioned a little bit earlier, all of our borrowers pay on the first of the month, no exceptions. And so we pay our investors out on the 10th of every month. That gives us some time to deal with, folks that may have had an issue with their banking or what have you. And then within that 10 days, we'll take care of that We pay all of our investors on a monthly basis. So a couple cool things here to note. Number one is that unlike some other funds that you're probably invested in where you might not see a return for a while, even if it's a great return, you may not see it for a year, 2 years, 3 years. You literally will see a return on your investment within the first payment. So if you invested, for example, today, which is the middle of October, on a loan that's closing, because we get interest for the remainder of the month, you'll, in your payment on November 10th, literally get your payment, your interest from that previous month. So you're collecting interest immediately, which is awesome. Another great thing as well, and this is, to date, we've been very good about, we've never missed an investor payment, basically. Not to say that would last forever, but certainly we're able to make sure that happens. So even if a borrower's got issues and we're working through those issues, the investors are always getting paid. At the end of the loan, when it matures, the way our process typically will work is we'll let you know that that loan has matured, we've received your principal back, and we really give you the option at that point of what you want to do. If you're happy and you're like, great, I made a couple bucks and I want to put that money back in my IRA or my bank account to invest elsewhere, no problem. If you like the process and like what you've been doing, you're like, you know what, I'd like to roll that money into another loan. What we do from a process perspective on our end is the folks that are getting loans paid off, we want to get that money back to work as fast as possible. So any loans that are either recently closed or upcoming, we'll make those loans available, kind of a first right of refusal on those to our existing investors prior to putting them on the marketplace. So you'll have a choice. You can do it either way. And once you make a decision on what you want to do, you're good to go. So that's pretty much it about the process. I think the only thing I didn't mention is the initial onboarding, and that's also really simple. You go online to our yieldi.com. You can just say, I'm an investor, I want to get started. You fill in a form. It takes about 5 minutes. You'll receive 2 documents back via DocuSign. The first is just a subscription agreement, making sure that you're able to participate in the loan and or participate in these types of investments as an investor. And the second is just an information form, which just makes sure we have your company name right, and if you're investing individually, your information as well as your banking information, so we know where to send those ACH payments. And in the case of Advanta, that won't apply as much because we'll understand with Advanta how to send that money back right into your Advanta IRA account. So Clay, with that, I think that's it for us at yieldi. I'm happy to answer any questions and give you back the presentation.
Thanks, gentlemen. I really appreciate that. I hope that you didn't notice this, but my power went out, and so I disappeared for a little while.
I saw a message pop up on the screen. I thought we were going to get kicked off, but Joe was doing such a good job that I didn't want to interrupt him.
Nicely done. Nicely done. Okay, so for those of you in the audience, please feel free to type in questions at this point. We have a couple of them that I wanted to ask, but if you have other questions, let's go ahead and type those in, and we'll be happy to answer those. And a couple of the questions that are in already are, is there an ability to get the slides from the presentation? And yes, if you email me at cmalcolm@advantaira.com, and I can put that up on the screen. I'm happy to send you the slides. Yes, show my screen from current slide. So hopefully that's showing up now. And so hopefully you have the contact information for both of us there. And okay, so let's start with the questions here. How do you guys deal source loans? Joe and Josh.
Hey, this is Joe. How do we source our deals? So we've got a big brokers network that we work with. There's probably 70 to 80 brokers that send us deals on a daily basis. We also do a lot of marketing. We go to a lot of conventions to meet mortgage brokers and closing attorneys. So we have a kind of a pretty large network of different types of people and professionals that send us leads. And then also, we market direct to borrowers. And so we're probably getting 10 to 15, we talked about this yesterday, we're getting an average of 15 leads a day that we're having to shuffle through. And so out of those 75 leads or so a week that we get, we may close one or two of them. So we're very specific on the deals that we do and the borrowers that we work with.
Okay. Next question. And there's a couple of them here that have to do with accredited investors. One of them is, do you have to be accredited accredited investor to invest?
Yes, currently you do have to be accredited to invest.
And and the second question is, do you have any plans to change that, or do you see an eventuality where that might change?
Yeah, we talk about it. I mean, there's been some regulation changes around that as well. The folks that set our fund up initially, they're very experienced in setting up different types of debt and equity funds. And, when we started to talk to them, they were like, look, this is by far the easiest way to get up and get going. The challenge a little bit with unaccredited investors is more the investment amount, right? So we never wanted to get to a situation where we had 100 people in a given loan. And so I think that's something we do take a look at, because even Joe and I have a lot of good friends that are very smart, and they're just not accredited investors, but they're really interested in what we do. So we need to come up with a way to do that, and I think it's something we'll probably address next year.
Okay, interesting. So given the 6 to 8%, how much do you charge the borrowers, and what's your spread, and how else do you benefit?
So the way that the company makes money is we get origination points at closing, and those can vary depending on the deal between 1% up to 3 or 4% of the principal amount that's being lent. And then usually the company makes about a 2-point spread between the difference of what we're paying the investors to what we're collecting. So if it's an 8% loan to the borrower, we're paying our investors 6%.
Got it. And this is something that the three of us were talking as we were kind of setting up for the webinar. So what is your plan regarding accepting IRA funds and/or liquidating the currently invested IRA funds if the proposed IRA legislation changes pass?
Yeah, it's a good question, and I know that's been kind of a hot topic in our space as well in private lending. Some of the consortiums and some of the legal folks in our space have been kind of talking through that. They're working with Congress, and the good thing is that it seems like the impact on us might be somewhat mitigated, but still there's going to be an impact. So, we'll have to play that out and see. Obviously, if we have a bunch of folks invested out of their IRA and that legislation passes, I'm sure there'll be some sort of date, and we'll make sure to replace those funds if we have to. Obviously, we hope that never happens.
Well, and I'll chime in on that a little bit too. I think that at the moment the language is vague enough that it's pretty hard for us to know exactly which investments would fall into the private kind of investment category. The second thing that we don't know, and this is very common with tax legislation, is that often there are logistics that get addressed after the basics of the legislation gets passed. Then there are directives on, okay, what does this mean? Define this term. What's the process, et cetera, et cetera. So I think it's pretty tough for all of us, both investment providers, but certainly for us as an IRA provider, to know exactly what the impact is going to be until it happens. I mean, certainly we are rallying everybody, at least in terms of the information standpoint, is please be informed about what's going on with that legislation. We've started a petition. We have sample letters for you to send your legislators, things like that. And specifically, if you don't know, the legislation has a number of different things that might affect IRAs, like perhaps a limit on the amount that you can have in one for certain, depending upon how much money you have. But the one that seems to be getting the most attention and has the most, seems like the most potential for a logistical mess is these private placement or private investments, and any investment that you had to be accredited to invest in and things like that? And will that apply to debt instruments as well as private PPMs and things like that? All these things are to some extent TBD. So I think it's hard for all of us to kind of address that without having some more specifics. But if anybody is interested in taking some action and letting their legislators know what they think about it or what they'd like to do, our blog page on advantaira.com has 2 blogs on there, and that talk about what the legislation is proposing and perhaps some ways to vocalize your concern. So happy to discuss that further, but at the moment it's kind of an unknown commodity. What is the size range of your loans, residential versus commercial, and smallest to largest?
Yeah, it's a great question. This is Josh speaking. Typically speaking, our average across our entire portfolio is about $700,000 today. That's to your point exactly, Clay, a little skewed because our commercial loans are larger than our residential loans for sure. But the range of loans that we're comfortable funding in is on the low end around $100,000, on the high end around $5 million. So that's kind of our playground, if you will. What we find is that on the low end, the amount of work to do a loan of $100,000, or even if it was less than that, is pretty much, within, especially in residential, the same amount of work as it is to do a $2 million loan. We also find that the borrowers, when you start getting above that, 500K to 750K mark, they're just more sophisticated. So, we like that a lot. We're getting, clean bank statements and financials. They have a very good exit strategy. They've got good experience, so they know exactly what they're going to do. At the end of the day, we need to recognize our rates are not cheap, and they can get to a bank, even if it's as hard as Joe was talking about, or an SBA loan if it's a commercial customer. And so they, these are 12-month loans, so they want to be in and out of these things and make sure they get that all buttoned up. So we love a good story and explanation and understanding that what this looks like. So that's kind of why we stay in that range. I think as we grow, there's some really good opportunities greater than $5 million and some institutional folks that play in that space. But we'll probably go there, especially with Joe and his family's experience and the multifamily side. We will probably get there at some point.
Okay. And how does your platform differ from Peer Street?
I would say, it's pretty similar. If you've used Peer Street, I would say the main difference, and there's a couple of the folks, there's not a lot of guys, but there's a few folks that do this on a national level that are, focused on debt. At the end of the day, the platform itself, pretty similar. If you've used Peer Street, you'll be comfortable and enjoy, working with our platform. I would say it's the quality of the investment of what we're looking at. So Peer Street's doing a lot of fix and flip. Yeah. And so we're originating all of our own loans. That's probably the most important thing. Peer Street's buying loans. They don't really have that relationship with the borrower. So, we understand the real estate and we understand the borrower, and we have those relationships. So it takes that safety factor up and reduces risk, by a few multiples for sure.
Okay. Thank you for that. And guys, if somebody wants to contact you directly with a specific question that's not super related to the webinar, do they get to you via info@yieldi.com, or how's best to contact you directly for a question like that?
Yeah, I mean, that'd be great. The info address goes to both myself and Joe, and actually Joe's brother Chris runs our origination process, but he'll see those as well. But certainly that'd be a great way to get started, and one of us will get back to you and can talk further about what it looks like to invest. You can also obviously hit us up on LinkedIn and Instagram as well. But info is probably the easiest, or just call us.
Okay. And let's see. I have a few more here. So, can you speak to your transactional funding product and your funding for note purchases on your website?
Yeah, so transactional, on the transactional funding side, we'll do some of those loans if it makes sense. We want to keep the time frame between them purchasing and then selling it to a very minimum. Obviously we love when they have it sold prior, get that closed prior to them actually buying it. But we'll again only do those when our borrower has their own skin in the game. We're not going to take 100% risk in those, and we're going to be comfortable getting those loans back, if we need to. We do pay out a little differently on those, obviously, because we're talking about, a 5 to 7 day loan at the most. So, we'll typically pay that out more as points to our investors if they participate with us in those.
And as far as, this is Joe, as far as the note financing, so if somebody is purchasing a note, then we'll come in and basically it's we're in first position on the note. So if we lend, we'll be in a first position to be paid back at 60-70% of the note purchase cost. So we'll still be in a senior position to the actual purchaser of the note, if that makes sense. But we do note lending on note purchases.
Okay. Next one is how many participants in a loan? I think you talked a little bit about this, and can you explain BPDN, please?
Sure. So participants in a loan will vary. If it's a $100,000 loan, we might put a $25,000 minimum on that loan, so that would be up to 4 people. If it's a $5 million loan, we're probably going to have a $250,000 minimum, and so it could be a greater number than 4. But I would venture a guess that across our entire loan portfolio, probably around 3 to 4 to 5 people in a given loan. So it's a pretty small group, which means you have a lot of sort of ownership of it, if you will. And yeah, Clay, the BPDN stands for Borrower Payment Dependent Note. And so the way that our fund has been set up, and certainly we're happy to let anyone review our PPM if that's if you reach out to us. But the way that our fund is set up is to allow investment into an individual loan itself. And so when we close that loan and we have yieldi securing that loan, we are on the deed in first position, and any of the investors that we have that have these signed promissory notes have their percentage of that total loan amount identified per this document. And so that's pretty much how it works, and that's what's securing your investment in each individual loan. And again, in both the BPDN and in our PPM, there's some specific language that talks about what happens in the event of a default of the loan. There's some specific language that talks about what happens if yieldi as a business has challenges. And so you're certainly happy to pass that through. But the summary of all of that is that it's the instrument that's used to secure the investment dollars against the loan in first position.
Yeah, so just a quick example. So if it's $1 million loan and somebody is investing $100,000 into it, then they'll receive that BPDN Borrower Payment Dependent Note, and it'll show 10% ownership of that loan, the amount that they invested, their monthly interest rate, their monthly interest payment, and then it'll be secured by that underlying asset. So for the life of that loan, that investor owns 10%, no matter what happens to it. If it goes in default, foreclosure, we take the real estate back, we sell it, they still have their 10% ownership in that loan, in that property. So they'll be secured by that BPDN.
Got it. Thank you for the example. Yeah, it's cool. Next one is if our group brings deals to you, and this is not Advanta, the lawyers would be upset if I said that. If our group brings deals to you, would you do a syndication? And what do you do with the deals you pass on?
If somebody brought us a deal, then yeah, typically we would, we hold everything on our balance sheet. We close all of our own loans, so we would fund the deal. If somebody brings us a deal, typically we pay them a referral fee or a broker's fee, and then we would fund the deal and we put it up on our marketplace and probably syndicate it or sell off a portion of it, whatever was left over after Josh and I invested in it. And then the second part to that question was,
What was the second half of the question, Clay?
What do you do with the deals that you pass on?
oh, the deals that we pass on, right now we move them to the trash folder. We really, unless it's a deal that we think can be funded and it maybe is out of our price point, if it's like a 15, 20, 30 million, 40 million, I mean, even up to $100 million like development deal, then we've got correspondent lenders that are partners that we send them to, and they'll either fund them themselves and pay us a referral, or we'll co-fund them and take a small piece of it. If it's a deal that's too small, then we might pass it off to another lender that that does loans that are fix and flip under 100,000 or 150,000 if we pass on it. But if it's a loan from a borrower that has no experience, then we just trash it and move on.
Got it. Let's see. So we have questions keep pouring in. We are gonna cut off here in a minute or two, but I have a couple more that I'd like to go ahead and see if we can get in here. But I do want to be respectful of everybody's time and close relatively close to 1 here, Eastern time. What do you guys see as the biggest risk to your model?
I think the model itself is sustainable. We ultimately need to continue to grow our investor base so that we have enough liquidity to go and be competitive in the marketplace. So I would say that would be number one, and secondly, on rates. As more folks and institutional money is entering the space, it's creating a bit of a consolidation on the rates. So making sure we can continue to get good loans with good rates, and then be able to offer those up to our investors.
Yeah, and then obviously the biggest risk to the business as a whole is just the economy. If the economy crashes like it did in 2008 and real estate values drop, I think back then the average across the board was around 20%. We'll still be okay in the loan positions that we're in at 65% on average, but it would just be dealing with a lot of properties and if there were a lot of defaults across the portfolio. But that's why we still feel safe at the loan to value that we're at, even in case of a market correction.
Okay. And this is going to be our last one, and then we'll, if you do have questions and you're typing them in, or you still have them in your head, we're happy to, I can get a report where the unanswered questions, and I can farm them out to Joe and Josh, or if they're for myself. We'll definitely get you the answers, so don't feel like you won't get the answers. It just may not be today immediately. So please do feel free to type in questions. If I don't get to them, I apologize, but we will get you the answer. How much skin in the game is required for the transactional funding?
It just depends on the deal. If there's a buyer that's got hard earnest money up and it's significant, non-refundable, then we'll take that into consideration. If we would have to underwrite the deal and kind of understand the real estate and the transaction. That's it. It's kind of hard to say without knowing specifics.
Right, so it is deal specific is what you're saying, yeah.
Yeah.
Okay. Excellent. Well, I'm going to go ahead and close it up for today. We're here at our 1 hour mark, and I just want to thank you guys, Josh and Joe, for joining us and sharing a little bit about yieldi and kind of debt investments in general. Thanks a lot for bringing your expertise.
Thank you. Yeah,
thanks for having us.
Yeah, and like I said to the audience out there, if you have questions that are in that you typed into the question box that didn't get answered, we will get those answers to you. And I certainly appreciate everybody who joined us today for spending some time with us to learn a little bit more about investment into debt instruments. And if you need follow-up information, please do feel free to reach out to myself for the IRA information and to to Josh and Joe at Yieldi for their information. So thanks a lot for spending some of your day with us, and I hope it's a great one for you, and we'll see you on the next one.